Thanks everyone for joining us today for the Australian Mortgage Innovation Summit. And this panel session is on a topic I'm particularly excited about. It's looking at financial wellbeing, and we're tying it in with the lending space. So my name's Anna Shaw and I'm Head of Client Insights for RFI Group. And I've got a really fantastic panel with me here today. So I have Dr. Lily Sussman, who is the Chief Strategy Officer at Wiser, Dr. Vanita Godinho, who is the CEO and Managing Director of Financial Resilience Australia, and Paul Feeney, who is the founder of Map My Plan. So a really good mix of perspectives to talk about financial wellbeing and financial literacy, and looking at this in the context of lending as well. And what I'll do is I'll hand over to my panel to introduce themselves a little bit further and give a bit of background into their role and also why financial wellbeing is important to them. So Lily, I might start with you.
Sure, yeah. So as Anna said, I'm the Chief Strategy Officer at Wiser. We're a purpose-led fintech focusing on personal loans and car loans. We also provide credit education through the Wiser credit platform and helping to even the playing field between borrowers and lenders. We also help people pay down debt faster through a proprietary app that helps them do that. Prior to Wiser, I was the Chief Strategy Officer at Social Ventures Australia. So I don't know if Vanita may have come across, worked with you before, but financial wellness is our purpose and something I'm really personally passionate about. I've sort of looked at this from both a lender perspective as well as a working on social disadvantage perspective. So I think it's really important that everyone in the industry cares about this and is having conversation about it. So I'm excited to join the panel today.
Absolutely. Thanks, Lily. Vanita?
Yeah, thanks everyone for inviting me to this session and talking a little bit about financial well-being. Just as an introduction, I feel that financial well-being has been at the core of my professional life for almost 30 years now. I've been a banker for a very long time. I've then done a PhD on financial well-being and capability building for Aboriginal Australia. And then I've been in a microfinance organization looking at safe and affordable finance for those on low incomes. And now I double hat. I'm the CEO of Financial Resilience Australia. And I also look after policy and advocacy and mental health issues at the Australian Psychological Society. So in many ways, my entire life has been about helping people to manage their money better so that they can improve their well-being. And that's why, to me, it's the core of my being, whether I'm wearing the hat of finance or I'm wearing the hat of mental health. Money, I think, cuts across every part of our lives. And I'm so delighted to be able to share some of my experiences with you today.
Absolutely. Thanks, Vanita. And Paul?
Yeah, thanks, Anna, for the invitation to join today and for everyone listening to us on the panel. I feel a bit lower down the totem pole, not having a doctorate, but nonetheless, we'll do our best with my fellow colleagues here on the panel. But financial wellbeing for Map My Plan is really about answering that one question that everyone has on their mind. What do I do next to improve my financial situation? To do that, you need to understand where someone is and where they want to go, what their goals are. And so Map My Plan is a self-directed platform that lets anyone build a personal financial plan that essentially answers that question. Everything from paying down credit card debt to building your rainy day fund, to what your retirement's going to look like, to making sure you pay your house off and looking after the kids. So it's really just focused on individuals and answering that one key question for them to help them understand what they can do next. Thanks.
Thanks, Paul. I think the idea of that, financial wellbeing being important for everyone is quite key, I think, throughout this session as well, when we think about the role of lending, but also the role of financial literacy. And I think that's probably a question I'd like to start with you, Paul, just looking at why is financial wellbeing and also that independent financial advice important to you? And how do you think this can actually help financial outcomes in Australia?
Yeah, like we said before, it's all about making sure people have got the information they need when they need it to make a well-informed decision. But there to be no other motivation behind it other than improving where someone is now so they can make those smarter decisions. The unfortunate thing is when we're giving advice, we think everyone thinks rationally. But really what we should be asking them to do is just to be reasonable about what they want to do. Everyone's got different goals and different things they want to do. And the financial landscape's very confusing. It's hard for people to understand what to do next. Most people have to go to Uncle Joe at the barbecue, and typically not a good idea. So it's really empowering people about that. And we've been working with employers to improve financial well-being for their staff for a few years now. pre-COVID, it was the reactions, oh, that's a nice, fluffy, nice feel-good thing to do, improve the financial well-being of our staff. Now, every single organisation we talk to, we do not have to even mention the need for improving the financial well-being of staff. Everyone is aware of it. They're just looking for solutions that can help their staff in that way. And I think it's something that it's a social good. If we can actually help people make better decisions, they're going to be better off. The community and the family they're within, society is going to be better off, and we can all do a bit better things as well.
Definitely. And I think that change from the pandemic, I think, is quite key as well. When you think about before, it was a nice to have, and now it's so critical. I think something that we'll talk about later on in the session is, I guess, the changing market as well because of the pandemic, and how what we used to just think was somewhat important is now just critical for the future as well. Vanita, I just wanted to ask you as well, thinking about your vast experience in a range of areas, including banking and academia and the nonprofit sector, what would you say some of your biggest learnings were having worked in a major bank, and how are you implementing these in the work you do at Financial Resilience Australia?
Yeah, so, I always like to talk in terms of three things that I've learned. So there's three things that I've learned throughout my career about financial capability and well-being. Is that first, that financial capability does not depend on income. So no matter what your income level is, your capability can be low or high. It's something that's individual. Financial capability, second point, is also influenced by a number of things, your personal characteristics, your personal attitudes, but also that of your household and your close family has a very strong influence on financial capability and ultimately your well-being. And last but not least is the recognizing the ecosystem around you, the system and the environments, the policies, the supports that are available. All three layers, if you look at the individual, their household and close family, and then the society around them, all three are important factors in order to improve financial capability and well-being. Another thing that I've found is that financial capability is actually not just about knowledge, as Paul has mentioned as well. It's about using that knowledge, which is skills, practicing that knowledge in real life, and then using that to change your behaviors over the longer term. So it's actually three things: knowledge, skills, and then the behavior. And it's only when you make the effort to address all three that you can genuinely improve financial well-being over the longer term. So to me, these are at the core of the social enterprise that is Financial Resilience Australia. It's a consulting firm at the end of the day, which designs products, services, and programs designed to help people to improve their financial capability and well-being. And I use all of these experiences in different ways, depending on what the client is looking at, to improve financial well-being, either for individuals or for their workforce or for the business owners. Because as the COVID has, the experience has revealed, small businesses now have the lowest financial well-being and are a group that we must really focus on when we look at improving well-being in Australia.
I think that idea that it's got multiple components is quite important as well. And I imagine, Lily, with your experience as well, having moved to Wiser from Social Ventures Australia, what are you doing at Wiser to improve financial wellbeing? And I guess similar to what I was asking of Vanita was, how are you implementing some of those learnings from your previous role in the work you do at Wiser, and how that work helps Australians with their financial wellbeing?
Yeah, I think the work that Vanita's doing and people are doing in the social sector and public sector around this is so important in helping individuals and business owners, small business owners, improve their financial capability. I think being on the side of the lender, there's also a lot that lenders can and should be doing to meet consumers, in the middle, in the right way. And, Wiser, because our purpose is financial wellness and everything we do is purpose-led, we've tried to reinvent what a lender can be, by educating people around the credit experience, helping them understand how to get a better deal and how to track and understand credit scores, how to pay off your debt faster. We've structured our products in a way where we encourage people to pay off their debt faster. And we are very careful about how we offer credit in a very responsible, caring way based on very careful assessment of affordability. And I think that care shows up in how we kind of deal with customers on a human level through each step and each kind of interaction point. And, I think there is a onus on lenders in a way, because there are a lot of good lenders out there who are providing streamlined credit, very fair rates, but it's not just about having access to credit when you need or speed or convenience. It's actually about, is it right for you? Is it going to put you on a better path? Is it giving you more security, helping you emotionally, helping you be empowered? Do you have a sense of control, sense of deeper well-being? I think having that broader and deeper values-based way of thinking about financial well-being, the holistic, mental health, everything else going on in your life, your financial situation, having that holistic picture of what is financial well-being and lending, in a responsible way against that is something that lenders can do. And people come to Wiser typically to consolidate their debts, or in this case, to take out gap finance so they can avoid the mortgage insurance. And they are making very considered investments in something very important to their lives. And it's an important moment to support people. And you've got to have very responsible ways of doing that and saying, is this right for you? And the onus is on the lender, not just the consumer. Like, I think everybody's responsible, but I think there's a lot of things that lenders can do. And I'm really proud that Wiser takes the time, and that's our purpose. So of course, we're going to do it that way. And I think what we've done in the last few years is prove that we can do things differently. You can have a consumer brand that's built around financial wellness, and you can provide credit in a safe and constructive way that helps people improve their financial wellness. I hope more and more, I think from the consumer perspective, building more financial capability is really great. And I think COVID has helped with awareness of that. And I think from the lender perspective, likewise, I think COVID has put this issue of financial wellness into greater relief. So we're thinking about it, and more people on the lending side are thinking about it. And I think that's all very good, moving in the right direction.
Yeah, absolutely. And I think you touched on as well the pandemic and how that's, again, it's this topic that's hard to avoid when thinking about how the financial wellbeing landscape has evolved and the role of lenders, and I guess thinking about how that ties in with even the role of credit, particularly when more and more customers are vulnerable, or they've seen their income be impacted, or they're needing credit for different reasons than maybe in the past. Potentially it could be for living expenses or unexpected expenses rather than a new car or a holiday. To start off this discussion about the role of credit, Benita, I might start with you, but what do you see the role of credit being for vulnerable populations or groups of people who have been impacted by the pandemic, in the sense that maybe they've had an income decline, or they're struggling to sort of make their, meet their needs at the end of the day?
Yeah, so I might just start with, what is the role of a bank or financial institution? It's to provide products and services that meet the needs of their clients. Yeah, so that would be standard for any product or service. And as a banker, I was always taught that there are three things that we do in order to help the client. We help them to transact, we help them to protect, and we help them to grow. So transact type products are your normal credit, your normal overdraft facility, or just your check account where you're making and paying bills. Your protect accounts are your insurance, your superannuation, your retirement plan, where you're protecting something in the future. And your grow is where typically things like a savings plan or a credit or a lending facility comes in. So the basic portfolio that anyone, no matter whether they're on a low income or a high income, needs is a little bit of credit, a little bit of savings, a little bit of insurance. So to me, I think that, credit is something that no matter whether you are a disadvantaged person or you're very rich, everyone needs some amount of credit. The difference between what a person on a lower income needs versus what a person on a higher income needs typically is the size of the credit, the length of time that they want to use it for, and the purpose that they use it for. So typically you would think that someone on a lower income would want small amounts of credit for short periods of time, and would want it for a purpose which is to make ends meet or smooth out household expenses, because typically their income is inconsistent. So that's typically what you would expect for someone who is in a disadvantaged situation. I think what COVID has exposed, though, that it's not just people on low incomes who needed credit for this kind of approach. Because savings had not been high across Australia, what COVID has done is reveal the fact that people who even are on middle incomes have needed to have access to credit in order to make ends meet and in order to just repay basic household bills, because for the first time, their income has also become variable and uncertain. So I think that, rather than thinking about what is the purpose of the credit at different stages, whether it's a disadvantaged community or not, the question is more the income variability. And if income is variable, no matter where you are on the strata, then in that case, you will need some sort of credit in order to smooth out your normal expenses. So I hope that's answered your question, Anna, in terms of what credit looked like given the COVID crisis.
I really like that example of, or that illustration of how credit is something that is important to everyone, not just those who are vulnerable, but it looks different for different needs and for different incomes. And even your comment about the less lower income, the more middle income, those people are still affected as well. And I think that's something else unexpected with the pandemic, where there's just more and more people who are experiencing more financial stress than they ever would have expected, 12 months ago, 18 months ago. Paul, thinking about financial well-being, what do you think financial institutions and lenders need to do to support customers who have been impacted by the pandemic or who are experiencing that financial stress?
Yeah, I think when it comes to provision of credit, I think they all go through the process and assess someone's current situation, where they're at and can they afford it. But I think what's lacking is the credit is not just a day one instance. It impacts someone's financial life continually. And they don't seem to take that into account, a lot of lenders. And if they did, they'd have to probably reassess what they're doing and how they're going about it. But by putting that litmus test and putting that lens over it, you can actually help educate the client about what this credit's really going to mean to you, not just to today, because they've got a hurt point and they just want that solved here and now. And the credit can do that. But that hurt turns into something else, and it can be quite dramatic on their financial well-being if they don't understand where it can get to and have the plan to actually get rid of that credit and move on and just build a solid foundation themselves. And that's the unfortunate trap that a lot of people fall into when they're borrowing money that's not backed by an asset that can actually appreciate, like a house. So I think with the best interest duties that's coming along, just for mortgage brokering at least, I think that's going to assist. But I think that should be then given broader across to the entire sort of credit space. And as Lily said before, Wise is taking a different approach. And if they put that lens over it, it really is great. Well, now we have to go along and we have to help the client understand what's the long-term impact rather than just getting rid of that immediate hurt point. The other thing that I've always found strange is that your new customers always get a better deal. Surely, if you're really about using lending to really help people improve their financial life, when you've got a better deal, give it to all of your customers. Now that's counterintuitive, but imagine if you're an institution that does that, where does your trust level go with all of your clients? They'll love you because you've got their back, but no one seems to take that approach. It's all about the transaction. Just get it done, move on. Another transaction, move on. And that's not helping people at all because they've got no idea about the context of what it's going to do in their future. And I think that's what's got to change.
That is such a great point, and it's something that we see in the RFI group research as well. When we look at why customers are unhappy or why they don't feel loyal to their institution, it's because they see new customers are getting special offers, they're getting cash back, they're getting lower rates, and they've been with the bank 10 years and they're feeling like, well, why don't I get that level of attention and special offers, the same way they do? So I think that comment about trust as well is something that is becoming more and more important, particularly when people, even post Royal Commission, customers want to know what am I paying? Firstly, they want that transparency of their rates and fees. They don't want to have any surprises. They just want certainty of costs, and they want to know that they're getting a good price for what, that products that they have.
And on that point there, there's standards we have to say this is what it's going to cost, but it's a generic person's cost. It should be what it's going to cost you, given your situation and your exact loan. This is going to be the cost, rather than this fictitious person who borrows $50,000 is going to cost that. People want to know how to fix them, not this fictitious person. So my call out to everyone there listening is like, pull your socks up, put the client first. It'll help in the long run.
Bringing it back to that human level, and I think the individual level is quite important. I think with the pandemic as well, people don't want to be seen as just another number. They just want to feel seen and that their individual circumstance is being appreciated, and the products are tailored to what they need. And I think, Lily, this is probably a good question for you, thinking about what Wiser is doing to help these customers who have been impacted by the pandemic, and how are they approaching customers in a way that is sort of seeing them as individuals?
Oh, absolutely. You know, since COVID's happened, we've had a lot of conversations with people who, and many conversations. You know, it's definitely not a transaction and then forget it relationship. You know, it's very much, let us help you. And we've had a lot of conversations where people are coming with very vulnerable stories. You know, they want us to know generally that it's not, no one ever wants to avoid their responsibility or debt payments. You know, they are responsible people, but they are in a difficult position, and it's a vulnerable, stressful moment for people. So we're having conversations every day. You know, our financial assistance officers, the unsung heroes at Wiser. His name is Joe, the person I just talked to last week, and he and I were talking about just incredible work that he does. And he's, you know, on the phone every day with customers, really listening. Firstly, really listening and really understand each person's individual circumstance. You know, there are, for example, you know, one of our customers, they had lost their job early last year when the whole COVID crisis was just getting started. Then they were able to find another job in the next month, and then lost it again when it was the real estate industry, and, you know, they were making a lot of layoffs. And this person was just, you know, so upset, losing 2 jobs in quick succession, experiencing depression, felt helpless, really worried that their credit rating was going to be negatively impacted, you know, and just wanted help to find a solution. And I think it's not alone. There are lots of people who I think, whether or not they had complete changes in job, they've had sort of downgrades in their shifts and time, and, you know, fluctuations in the income, and often combined with someone getting sick in the family, or, you know, something's happening during this period, and they're just looking to be supported and helped. And I think we've been working really hard to kind of spend a lot of time with people, really helping them understand all their options and the impact of every little choice. You know, how does going on a hardship plan impact your credit score versus, you know, extending your loan? Does that increase the interest or not? Like, giving them all the options and really helping them think through it. And, you know, some people have chosen, for example, to take out money from super and to repay their debt, and that may have been the right decision for them, you know, because they didn't want their debt to accumulate. You know, now that has implications, and we don't know at a broad level the implications of taking out super, you know, long term yet. But I think it's very much, as Paul said, really an individual circumstance thing, and lenders have to take the time and the care to spend that time and to call people and to really give them as much empowerment as possible. And so, yeah, we have been really doing a lot in terms of just investing in time with customers, helping them through this hard stage, and providing as much as we can, not just the education and the here are your options, you know, here's what other people have done in your situation, but also trying to be emotionally supportive along the way, recognizing that it is such a difficult time, you know, and we want people to be engaging with us. We want to hear their stories. We want to know what's going on. We don't want it to be transactional, because that doesn't really work for anybody. It's not good for anybody's well-being.
Absolutely. And I think that comment about the early access to super is quite relevant as well to thinking about this year and last year, and sort of the different opportunities customers had to access these different options for support. And you make a good point where for that customer that you described, you know, doing something like early access to super really just works. It just helps them get out of debt. Or for other customers, maybe it wasn't the right decision. And Paul, I'd like to direct this question to you, thinking about financial literacy and consumer understanding of different things, particularly loan repayment holidays. And, you know, even now, as these repayment holidays are coming to an end, what do you think the impact could be for this? And do you think customers did understand the longer term impacts of something like a home loan repayment holiday?
Yeah, I think I'll start with the last question. I don't think that they fully understood. I don't think everyone fully understood that impact, because all of a sudden now they've had a holiday or a reduction in their payments, and people's behavior changes to meet that. And then all of a sudden it's a hard wall and you now have to change again back to what you were doing before. And in the meantime, did they go and build up a bit of a safety net or get ahead of their payments at that sort of stage? That's the sort of conversation that should have been happening when it was offered. Hey, it's going to cap in X number of months, you're going to be back to this. Here's something you can do to make sure that when you enter that, it's not going to be a big shock and a hard sort of entrance on that front. And I think the superannuation access, I think it was an absolute lifeboat for a lot of people. And they just went and did it, which is fair enough. A lot of people didn't, they didn't need to. But I think it was a lifeboat that many, many people needed. So on that front, it was good. But the impact is going to be dramatic, but in a couple of generations' time. Or let me put it this way, 10 elections cycles time. So they won't have to worry about that, the guys who made that decision. But it comes back down to when you've got credit for a client, you've got to explain to them the long-term process here, because almost all credit is long-term, the longest one being your home. It's really understanding that. And this is where it comes back to the best interest duty that's been introduced at the start of the year. So now mortgage brokers, even if it's not an actual mortgage for your home, if it's a credit facility, but you're a mortgage broker, you now have to take into account a person's broader circumstances and make sure that you find a product that fits them. Yeah, that's on the mortgage broker now. So you need to gather more and more information and put that debt in the context of someone's life to be able to assess and say, you know what, I did a search and this one meets what they need to do. So that's a lot more onus on them, which I think is a great thing. But if you take your client along with the education, they're going to go in there with eyes wide open and know where they're going. So it can help them in the long run, but as long as the old buyer beware, it's like, well, I think the credit provider needs to be aware as well of what they're getting a client into.
Yeah, there's some great comments there about the role of both the customer in understanding what they're doing, but also the lender and the broker, and really making sure customers do understand what they're accessing, and also taking into account the specific situation of that customer as well. Vanita, did you have any comments to add to this idea of the different support measures customers accessed, and what maybe the impact could be when some of these repayment holidays and even things like JobKeeper do come to an end?
Absolutely. So look, I'm hearing what Paul and Lily have said, and they're absolutely spot on. When these decisions are being made, sometimes, we call it concrete thinking from an academic point of view. People just want to get what is in front of them done, and they're not thinking broad term. And sometimes it's not possible for them to think broad term as well. So I think that if the lender can take that approach of taking the time, as Lily has mentioned and Paul is talking about, to get them to be able to think some practical steps forward, I think that'll be really great. Another thing I just wanted to put into the mix is that very often we think that this is something which is doing good on behalf of the lender. But we've actually done a lot of research on this while I was with microfinance, looking at the business case for taking this kind of proactive approach and helping the client to manage their credit better. And there is a strong business case that every organization can actually build. By helping your clients to repay their debts better, you have fewer arrears, and the cost of collecting that debt and managing someone who's in hardship actually becomes lower for the organization. It reduces customer complaints, it increases staff satisfaction and engagement with their job. And these can be measured in real dollar value. And we created the business case for lenders and credit providers to proactively offer preventative approaches so that their clients do hardship, and the business case was clear. So all I would say is it's not just a good thing to do, and it's not just because the regulator is now encouraging you to think about it. It's actually good for your business, and there's a business case that you can make in real dollar terms, which at the end of the day, commercial enterprise needs to tick off as well.
Yeah, it's a good point around the fact that it helps the lender as well. If customers are paying their products in a way, they're understanding how to pay their products, how to meet their debt, how to manage it responsibly, then it also does help them. So I think that perspective is definitely valuable, and thinking about the longer term benefits as well of customers actually understanding the products that they have. I think something else that we've seen with the pandemic is that RFI Group research shows that 1 in 5 loan holders have actually taken out a personal loan for living expenses or unexpected expenses. So like I mentioned a little bit earlier on, where previously you might have taken out a loan for something like a holiday, which is definitely not something you're able to do or as inclined to do these days. thinking about the impact of these short-term loans on credit scores, particularly in the context of applying for a home for the first time, how do you think financial education can help customers manage these loans and maximize their chance of buying a home in the future? Just to take it back to that home loan context. Paul, I'd like to start that one on you, if that's okay.
Yeah, in the pandemic, we did some research in May, right in the middle when everyone was locked down. And the top 3 stresses of everyone was job security, not having an emergency fund, and thinking I'm going to have to either use my credit card or get a personal loan to make ends meet. The interesting thing that happened though is the savings rates of Australians actually went up and the average balance of credit cards went down during that period. And we only found that out, 6 months later, but in the midst of it, everyone was quite concerned about it. I think what you need to do is you need to allow someone to stop looking at the immediate thing in front of them, the pain point, and show them the broader perspective of their financial life and what they're trying to do and so forth. Because managing your finances, it's a trade-off. It's a triage. It's about money I've got. These things here are important to me, but if I don't do that, then I can do all these other things. But people don't have the context because it's hard to get advice, to get that context for them. So if people have got that sort of perspective, it makes it a lot easier and the stress levels go down. If you've got a plan in front of you, naturally, even if it's 100 steps to get where you want to, your cortisol levels, your stress levels decrease. And therefore your reaction to, gee, I've got to go and put this fire out, I need to go and get a loan or whatever it may be, maybe it allows you to step back and consider it a bit more because you can actually understand where you are now in the context of where you want to get to. Maybe things are going to take a little bit longer, but I don't need to go and do those sort of things. So it's really making sure people have got access to that advice, or at least access to that context of where they are, I think will help them make better decisions. But these surveys now are still saying the biggest concern for Australians is having that emergency / rainy day fund. If you've got that solid foundation, you can weather a storm. You're still going to need some credit and stuff and so forth, but at least you've got a buffer when things don't quite go to plan. And I think if we get more Australians at that level, they're going to be significantly better off and their well-being will be far, far better off as well.
Yeah, absolutely. I think the role of a financial buffer just has so many different benefits to it, where it's even not needing to lean on a short-term loan or being able to just access that and dip into it when something does happen, like the power goes out or something happens with your house or you've got a bill that comes up you didn't expect. And I think, yeah, what you mentioned really does highlight how important that is, especially going forward. Lily, from your perspective, you mentioned earlier about debt consolidation. Is this something that you've seen more customers coming to Wiser for consolidating their debt, or is it sort of in line with what it was prior to the pandemic?
Yeah, no, absolutely, that has grown. And I think what we're increasingly realizing is that it can be quite hard for people to understand the differences between different types of lenders. Lots of people, are coming because they were once advised by a friend, they got a payday loan without understanding, they put big purchases like their wedding on their credit cards. They didn't really realize the consequences. So this goes, as part of what Paul was saying, not only do they not think about these types of credit within the whole broader picture of their finances, they don't even understand the individual types of credit and what is a sort of credit that you may not want to be putting. You may not want to be putting your wedding on your credit card, or you may not be wanting to take out a payday loan, especially once you understand the consequences, realize you can avoid that. I think we're experiencing a lot of people who are coming to us with they got stuck in a situation because they didn't understand the differences between different types of credit and lenders. And, we're trying to educate them on it and their options. And, if debt consolidation is the right thing for you, that can put you on much more solid footing and a very concrete, visible path to how you get out of debt. And I think, there's just a big range of credit products out there. They're all trying to market to customers and they're very unequal. So I think the lenders need to articulate that, and the consumers also need to be aware. So, in a lot of cases, people are coming to us and they are hoping to learn about credit. We try to educate people whether or not debt consolidation loan is right for them. We try to explain the options and teach them sort of how to think about different types of credit. And so every touch point they have with us, hopefully, is one where they come away a little bit more educated, a little bit more empowered.
Yeah, I think that I like the idea of empowerment as well. You know, you empower customers with understanding of how to manage their products, understanding of the products they have, and also the role of credit and when it's maybe the right thing to do, or when maybe something like having an emergency fund is a different solution for them in the future. I think, Lily, I'd also like to ask, given you're, at Wiser, it's quite, in thinking about, I guess, new and innovation and fintech, I think there's definitely a role for fintech to help with financial inclusion, including, providing credit and lending products that are tailored to customers' needs, or they are a bit more digitally focused or easier to manage. What do you think the role of fintech is to actually help with financial well-being, particularly in the context of lending?
I think fintechs, because we're quite agile and digital, we can sort of use digital technology to create well-presented tools, education, tell stories, and we can engage the digitally savvy generations, more and more of whom are realizing that finance actually matters, and their previous behaviors might be starting to catch up with them. So I think fintechs can use technology to help, but you need to have the purpose of helping. And then you can design great products and tools that cover the whole spectrum of education or better credit products, better services in a range of ways. And, I think Paul, Map My Plan is a great example of using digital technology to help people see all the bigger picture, different things, and connect dots. We're trying to help people connect dots between credit and how to think about that. But Paul's doing work of helping people to connect the other dots too, like what's your relationship between your retirement and your debt and your savings and your mortgage. And I think there is a great role, and I don't want to say just fintechs. I think traditional financial services providers too also have a role, with the scale that they have and the sort of reach that they have. Everyone has a role, and everyone can use digital technology to support financial well-being.
Paul, did you have any comments to add on that when thinking about Map My Plan and sort of the work you're doing as well?
Yeah, for me, technology, it's the solution for scale. It's how you give access to more and more people. And for us, our equivalent is a face-to-face financial advisor, which a lot of people can't afford, because rightly so, the most expensive part of getting advice is the person's time who's sitting across the table for you. They need to be paid, and rightly so, they need to be. So our platform basically is a self-directed platform that lets anyone build a financial plan themselves. They get to a certain level, they'll go out and reach out and they'll find an advisor themselves. But there's 8.5 million households that don't get access to that. And with the digital technologies, all of a sudden they can get that. And it's just giving them the ability then to basically just talk about where they are and what they want to do. And the algorithms essentially just tell you what you should do next. And when you link your bank accounts, you create a living plan so that next month when you log on, all your information is updated. The feeds from Wiser come in, the feeds from emails come in, and all the advice is recalibrated to take into account the exact situation at 2 a.m. that day when we updated it. So you know what you should do that day. And that's really the role that it can take. It can allow more people access to services that weren't available to them previously because they were based on a face-to-face relationship, which is based on someone's time, which is expensive. And so that's, I think, is a solution there. But it's also then enabling, when you plug different technology together, you're enabling even a better journey for the clients as well. So it's really looking at those hybrid opportunities that are out in the marketplace. And we're talking to many firms, including Lily, about how we can all work together to try and improve better solutions for clients.
Yeah, I like your point around accessibility. So actually enabling people who wouldn't normally be able to get a financial planner, giving them the ability to get that specialized advice for their situation in a way that's just a little bit easier compared to seeking financial advice.
If you put it in the realms of a mortgage broker needing to get, best interest duty for a client, you've got to gather all this information. Well, what better way to stress test the suitability of a loan for someone than plugging it into their financial plan? Imagine being able to do that. Someone comes to them with a pre-built financial plan digitally done. Oh, great, let's stress test that loan for you, not on day one, but through your life, and see how it's going to project out. There's no way anyone can't say that you haven't put the client's best interest at heart when you do that for them. And so that's the sort of thing that we're trying to do with different organizations to help them do that. And that's how you can work with mortgage brokers or any other lenders in that space as well.
Yeah, and that's exciting as well, just thinking about how to make things easier. And I think that just shows how innovation can actually help a lot with something like a home loan application, particularly if a customer does have more complicated needs, or there's something like they're self-employed. It means they've got that tailored advice already, and that source of information about their situation that can actually help them when they are looking to get to that next step, buy a home, things like that.
Yeah, it can make the process easier,
Yeah.
but it also puts you in context of everything else, so they can see the trade-offs that they're going to have to make.
Yep.
And all of us, when we go and get a home loan, of course you cut out expenses because you want to keep your home.
Yeah.
But it's the process to get there. Let's make that easier, and then make the impact of that make it easier for people to see what the impact is and what they're going to have to do to manage it.
Absolutely. Vanita, did you have any comments on the role of fintech and technology in how financial inclusion can be improved?
Absolutely. Look, I completely agree with Paul and with Lily here that fintech is the way of the future in order to access at a low, safe, affordable cost many people who could previously not access many of these things. And what I really like is the ability, because they're agile and they're using technology, to be able to bundle experiences. So this whole concept that we're talking about, previously education, when it was offered by the traditional banks, would be just in case. So here's the education and here's the product. Whereas what fintech is allowing you to do is do just in time. So here's the product, and as part of the service delivery, here is the education telling you what this means, what the consequences are. So that is the best way to build capability and confidence in people, give them the information that they need when they are making the decision, rather than at a specific point in time, which they might have forgotten by the time they get to that product. So to me, absolutely, fintech needs to be at the center of allowing access to low cost, safe, affordable products. The question is whether or not the fintech will be able to become sustainable if it has this kind of good in mind. And I think that in Australia, that's the struggle that a lot of fintechs have. But then, some of them have very successfully integrated the model and become sustainable as well doing that. So it shows the way forward that it can be done, do good, and be good for business as well.
Yeah, I think it's a really good point. And I think you've touched on that idea of what it will look like in the future as well, and how it does need to, looking at how these opportunities can be sustainable and can continue to make an impact in the future, particularly in Australia, where that's what we're looking at today in terms of financial wellbeing and the lending space. And I think to wrap up this session, I'd love to ask each of you what you think financial institutions and lenders need to do to actually ensure that financial wellness and financial inclusion is central to the products they're offering, both in the context of the full range of products, but also for lending products specifically. Lily, I might start with you for that final question.
Yeah, I think it always starts with people, and anything important in the world starts with people. And it's about leaders. And as humans, I think everyone, actually, not just leaders, but as humans, we fundamentally operate on the level of emotion, more than conscious thought. That's the biology of our brains. And that means having an emotional connection, an emotional commitment, having a moral purpose, set of deeper values. That's a core driver of behavior and what you end up doing day to day. And so if you are feeling something deeply, you're committed to values, what you'll do is you'll work hard to find that overlapping Venn diagram where the customer's well-being and interests intersect with those of your shareholders. And that's where all organizations, all business should be. It should be creating value for the customer, a portion of which then deserves to go to your employees and your shareholders, investors, your community, your stakeholders. So I think really knowing and feeling what that value is, having that kind of longer term, deeper definition of financial wellness, financial well-being, that deeper definition of value, not fleeting short-term convenience, but kind of deeper financial wellness, that conception of customer value, that's for every leader and employee to define and visualize for themselves. And if you do that, and that ends up shaping and setting strategy. So financial institutions out there are not asking themselves what value for the customer truly is, thinking about value in that deep way, about humans with emotional needs. And I think it may be harder for them to come up with an aligned strategy, which then generates the right business models. But I think, as Vanita said, the business case is clear. and there is a track record, Wiser being one of them, where you can do that, and that's the right thing to be doing. And it also creates much more passion in your workforce and connection and meaning and purpose, which we're all looking for and everyone deserves.
Absolutely. Can't agree with that more. Paul, any further comments to add?
Yeah, it comes down to putting the client at the center of everything. You know what I mean? And I mean, I've been a private banker and a planner and lots of stuff, and been in banks for about 15 years, and people behave the way they get rewarded. It really is that simple, unfortunately. But if we reward them differently, their behavior is going to be different. I mean, and for a mortgage broker, your job's not to sell mortgages. Your job is to help fulfill a dream for someone, to secure the financial future for them and their family, and take and be there with them through one of the most stressful times in their entire life of purchasing a home. Yeah. And then the way you help them that little bit more is to find that suitable product that costs them as minimal as possible, but has the features and benefits that they need to do what they're trying to do. So don't start off with, I'm trying to sell a mortgage. I'm trying to help someone fulfill a dream and a desire that they've got for their family. The mortgage is just the tool that you're using. It's not actually what you're delivering for the client. So I think it's an awfully subtle, different way of looking at it. And there's going to be people in the audience going, oh, mamby-pamby, whatever, I'm out here to sell my mortgages. But if you look at your client in the eye and you ask them afterwards, 9 out of 10, they're going to say, yeah, I just need help to secure this home. And I want you to take away the stress of getting it there for me. And I think if we can take that different approach, then that will make a big difference to the way that we approach what we do for clients. So it's really having that sort of perspective, I think, that people need to have.
Yeah, and buying a home is such a big step. It's a big milestone that people are ticking off. And I think, like you mentioned, that support throughout that journey is so key, especially when people are already stressed as it is with whatever's going on with work and family. And I think, yeah, just recognizing that it is such a complex part of people's lives is really important.
Yeah. Yep.
Vanita, any further comments to add?
Just like to, challenge ourselves to address the gaps. So for me, it's so wonderful to see that in the last 5 years, this concept of well-being has become recognized globally. Banks and fintechs in Australia are starting to take up the challenge and do these things, but I'm always looking for what's missing. And to me, the home, we're talking about mortgages. The home is not just a place for individuals to live in, it's also becoming a place where they work. So to me, I'm always thinking also about what is the gap that we've got here. And to me, the gap is small businesses. They have neither been recognized in the whole definition or research on financial exclusion. They have really been neglected in the concept also of what does financial well-being mean for these small businesses. They're 98% of all business activity, the engine of growth, yet they are quite neglected because our focus tends to be on individuals and households. So my next challenge from Financial Resilience Australia is to look at financial wellness and what it means for the small business. How can we measure it? How can we define it? How can we look for the root causes of the lack of financial wellness? And then how can we design programs that work for that sector rather than try and take something which works for larger workplaces and expect that it would meet the needs of small business owners, which all of the research shows it doesn't. So they are the one segment that has been shown out in COVID as being the worst impacted. Their financial well-being has really worsened. And to me, I'd really like to work the next a few years on how we can support small businesses in addition to the fantastic work that people like Wiser and Paul are doing for individuals and households.
Thanks, Vanita. I think that's a great question to leave us all thinking about as well, in terms of who's been affected and beyond just individuals, who else is being affected. And also, I like that comment about the role of the home. A lot of us are working from home. I'm pretty sure all 4 of us are at home today. And I think it's a good thing to bring up when thinking about a home is not just where you live, but it's also where you work. I think that's going to be quite key, especially as more and more workplaces become more flexible and actually start to let people work from home when it suits them, or juggle family and work in a different way than maybe a few years prior. Well, thanks very much for everyone for joining us today and for my amazing panel. I think there's been some fantastic discussion on both lending, financial wellbeing, and home loans as well. And just can't thank you enough for being part of it today. So thanks very much. And everyone who's dialed in today, enjoy the rest of the conference.
Thanks a lot.
Thanks,
Thanks
guys.
so much. See you later.